Value Investing Trap 3: Goodwill and Intangible Assets. In the first two episodes of this series, we looked at two places where retained earnings can disappear: working capital and property, plant, and equipment. Today we're looking at another one: Goodwill and Intangible Assets. This one is a little more technical and perhaps less intuitive. Still, it's very important. Because a company can grow its revenues, grow its earnings, and even grow its book value, while creating surprisingly little value for shareholders. A company may look cheap on earnings metrics and even look like it's growing profitably, but the shares simply don't move in tandem with the numbers. It's a classic value investing trap. This episode will get a bit technical, but I'll try to make it as simple as I possibly can. There's no way around going through some accounting if we want to understand this properly. The value trap starts with a company making acquisitions. Let's say we have a company that earns $10 million. The management has a choice. They can pay those $10 million to shareholders, or they can retain the money and invest it. Perhaps they decide to buy another company. Imagine our company buys another business for $100 million. The acquired company has $60 million of tangible net assets, $20 million in cash, $20 million in inventory, and $20 million in machinery and buildings. We pay $100 million for the company. So at first glance, there's a $40 million difference. But we can't simply call that $40 million goodwill. We now have to look more carefully at what we actually acquired. Perhaps the company has valuable customer contracts. Perhaps it has a strong local brand. Perhaps it owns a patent. Perhaps it has valuable technology. These are identifiable intangible assets, and they have real economic value. So perhaps we determine that the customer contracts are worth $10 million. The brand is worth $5 million, and the patent is worth another $5 million. So now we have identified another $20 million of assets. Whatever remains after this procedure becomes goodwill. In this example, that would leave $20 million of goodwill. This is where things get interesting for investors. The accounting problem. Who can truly say what the economic value of a brand is? 5 million, 10 million, 20 million. And how long will the customer relationships actually last? 3 years, 5 years, 10 years? There are accounting rules governing this process, and companies often use valuation specialists. Management cannot simply pick whatever number they want, but there are still assumptions involved, and those assumptions can have a significant impact on future reported earnings. This matters because goodwill and identifiable intangible assets are treated differently. Goodwill is not amortized under IFRS. Instead, it is tested for impairment. But many identifiable intangible assets, such as customer relationships, contracts, and technology, have finite useful lives and are amortized over those expected lives. So imagine two companies making exactly the same acquisition. One company ends up recognizing more of the purchase price as goodwill. The other recognizes more as customer relationships and other finite-lived intangible assets. Here's the important distinction. The first company will have better earnings in the years to come, despite the companies being identical. Needless to say, there's many ways for these intangible assets to fool investors into value investing traps. Many simply take the reported numbers on face value and trusting the accounting. This is a dangerous endeavor. Okay, enough with the overly technical part. After we have made the acquisition, the company is indeed bigger. Revenues increase, EBITDA increases, EBIT increases. On the surface, everything looks great. The company is growing. The key question remains: did the company actually create value? Or did it simply take shareholder capital and use it to buy another company? This brings us back to the central theme of this entire series: It doesn't matter whether retained earnings go into inventory, factories, or acquisitions. What matters is the return we earn on the retained dollar. Organic growth versus acquired growth. Let's compare two companies. Both earn 100 million. Both grow earnings by 10% per year. Company A grows organically. It requires very little additional capital. Most of its earnings can be distributed to shareholders. Company B grows through acquisitions. The income statements may look remarkably similar. Both companies have 10% earnings growth, but economically, they are completely different businesses. Company A may be able to pay out most of its earnings and still grow. Company B has to retain its earnings, perhaps raise debt, perhaps issue shares to finance acquisitions. And if those acquisitions doesn't generate attractive returns, shareholders may be getting very little economic value from the growth. So again, don't compare earnings to earnings. You need to understand where those earnings come from. The problem with adjusted earnings. Now we get to another important part of this value trap. After making many acquisitions, the company may eventually discover that some of the acquired assets aren't worth what the management thought at the time of the acquisition. Perhaps the acquired technology has become obsolete. Perhaps customers are leaving. Perhaps the expected synergies aren't materializing. Or perhaps management simply paid too much. Eventually, the company may have to impair goodwill or other intangible assets. Suddenly, there's a large accounting loss. But what does management often do? They tell investors, don't worry, it's a non-cash charge. Let's look at adjusted EBITDA. The underlying business is doing just fine. Technically, this is correct. The impairment doesn't involve a cash payment today. But that doesn't mean that it doesn't matter. The cash went out the doors years earlier when the company made the acquisition. Another problem with adjusted EBITDA figures are so-called one-offs. A typical example is restructuring costs. Management may say, this restructuring is a one-off cost, so we exclude it from adjusted EBITDA. But ask yourself, why did the restructuring happen? Perhaps the acquisition didn't perform as expected. Perhaps the expected synergies never materialized. Perhaps management needs to reduce employees because the acquired company isn't as profitable as expected. In other words, the restructuring may be evidence that the acquisition didn't work as planned. And if restructuring costs happen every few years, are they really one-offs? This is an important principle. Don't ask whether an expense is non-recurring. Ask whether it's non-recurring for the business model. If a company restructures every year, restructuring is clearly part of the economics of the business. It can be a normal cost of running a large company consisting of many previously acquired businesses. The same principle applies to acquisition costs. Perhaps the company pays lawyers, advisors, and investment bankers in relation to an acquisition. Technically, that cost relates to one specific transaction. But if the company makes acquisitions every year, acquisition costs are economically recurring. If the company stops acquiring, it stops paying those costs. But then it will also stop growing. The acquisition machine is the business model. So why should we pretend that the cost of running the machine doesn't exist? The new CEO phenomenon. Goodwill can remain on the balance sheet for years. Management has every incentive to believe that acquisitions will work. After all, management made the acquisition. They presented the synergies, the growth opportunities, and believed in the expected returns. Nobody wants to admit 2 years later that they paid too much. So the goodwill can sit on the balance sheet for years. And then a new CEO arrives. Suddenly everything changes. The new CEO wants a clean slate. They review the acquisitions made by the previous management team. They discover that some assets aren't worth what they are carrying at. And suddenly the company announces a massive impairment. Millions of dollars of goodwill disappear. customer relationships are written down, technology assets are impaired, and management says we have now cleaned up the balance sheet. Well, perhaps, but that doesn't mean that shareholders didn't pay for those assets. This is why the balance sheet is particularly important when analyzing serial acquirers. Look at shareholders' equity. Then look at what actually makes up the company's assets. Perhaps the company has $1 billion of shareholders' equity. Sounds reassuring. But what is underneath it? Perhaps $600 million of goodwill, another $250 million in customer relationships, trademarks, technology, and other intangible assets. Suddenly, very little of the company's book value represents tangible assets. This doesn't automatically mean that the company is bad. A company can have enormous economic value in intangible assets, as well as in assets that aren't on the balance sheet. So for investors, what is the solution to this problem? The most important thing is to look at the cash flow statement and analyze whether previous acquisitions have generated additional free cash flow. Furthermore, never take management's adjusted EBITDA numbers at face value. Plenty of companies highlight EBITDA because of the non-cash charges from amortization of, for example, customer relationships. Many of these companies are right to highlight EBITDA. Amortization of customer contracts and trademarks is non-cash and doesn't always reflect the economic reality. Companies like Lifco and Lagercrantz deserve to be in this category. Other serial acquirers of worse quality may not be right to highlight their EBITDA numbers. A customer contract may be amortized over 5 years, but the economic value may only be 3 years. In this situation, the amortization cost is actually lower than it should be. Fast forward a year, and the company gets a new CEO after disappointing growth. Suddenly, the company writes down the entire customer relationship, as well as some of the goodwill on the balance sheet. This is why you need to understand what is actually underneath the accounting numbers. The economic value of the goodwill and intangible assets may be lower than the balance sheet suggests. Meanwhile, the company can continue growing revenues and EBITDA without creating value for shareholders. Finally, I will wrap up the common theme of this series. A company can look cheap on earnings. It can grow revenues, it can grow EBIT, it can grow book value. But none of these things automatically mean that shareholder value is being created. If the company has to continuously deploy capital into acquisitions to produce the growth, you need to understand the return on that capital. If a large proportion of the company's assets consists of goodwill and acquired intangible assets, you need to ask yourself what those assets are actually worth. Because goodwill can make a balance sheet look stronger than the underlying economics, and impairments can arrive years after the capital was actually lost. So when you see a company with a long history of acquisitions, growing revenues, and apparently cheap earnings, don't just look at the PE ratio. Look at the acquisition history. Look at the organic growth. Look at cash flow. Look at the balance sheet. Look at what management excludes from adjusted earnings. And most importantly, look at where the retained earnings are going. Because sometimes the earnings aren't compounding shareholder wealth. They're simply being converted into goodwill, kicking the can down the road. Thanks for listening.